So let me ask you something, and I want you to actually sit with this question for a second, not just scroll past it. If someone told you right now, like a person you trust, someone who actually knows what they're talking about, if they told you that you could become a millionaire on a pretty ordinary income, without a side hustle that consumes your entire life, without inheriting money, without stumbling into some crypto moonshot, would you believe them? Probably not, right? And honestly, that reaction makes complete sense, because most of us grew up with this very specific, very stubborn idea of what a millionaire looks like. It's the entrepreneur who risked everything, the tech genius who built an app, the person who just knew to buy Amazon stock in 1998. Millionaires, in our heads, are people who did something extraordinary, something exceptional, something we, with our regular salaries and our grocery bills and our complicated feelings about saving money, probably aren't going to do. And so we kind of opt out. Not consciously, not in a dramatic way. We don't sit down and say, "I've decided I'll never be wealthy." It's quieter than that. It looks like putting off opening an investment account because you don't feel like you know enough yet. It looks like telling yourself you'll start saving when things settle down. It looks like spending $500 a month on things that feel good right now because the future feels too abstract and far away to really compete with the present. My name is Emmy, and I spend way too much time thinking about money, specifically about why smart, hardworking people stay stuck in financial patterns that don't serve them, even when the math for building real wealth is sitting right there, completely available, waiting for someone to just look at it. And that's what we're doing today. Because here's the thing, that $500 a month number I just mentioned, it's not clickbait. The math is real, and once you actually see how it works, not just the numbers, but the why behind the numbers, the mechanism, the quiet engine running underneath all of it, I genuinely think it's going to shift something in how you see your own financial future. So let's slow down, walk through this properly, and talk about what's actually happening when money compounds over time, because it is, without exaggeration, one of the most surprising and underappreciated forces in personal finance. The concept nobody really teaches you. Here's a question I want to start with. When you were in school, at any point in any class, did anyone sit you down and show you, in real numbers, what happens to money when it grows for 30 years? Like, not a vague saving is good lesson, an actual demonstration. Here is $500, here is time. Here is what the combination of those two things produces. Most people I talk to say no, and I think that's a huge part of the problem, because compound interest, the force that turns $500 a month into $1 million, is genuinely counterintuitive. It doesn't feel the way it works, which means most people underestimate it in ways that quietly cost them hundreds of thousands of dollars over their lifetimes. So let's start at the foundation. What is compound interest actually? Simple interest is straightforward. You put in money, you earn interest on that money. Easy. Compound interest is different. With compound interest, you earn interest on your money, and then you start earning interest on the interest, and then interest on that interest, and then interest on all of that. It folds back into itself over and over, accelerating as it goes. The way I like to think about it is a snowball rolling down a very long hill. At the top of the hill, the snowball is small. Rolling it doesn't produce much. But as it moves, and this is the key part, it picks up more snow with every rotation, and the more snow it has, the more it picks up. By the time it reaches the bottom, it's enormous, not because you added more snow, but because you gave it time and a hill. That's compound interest, and here's what makes it surprising. The snowball doesn't grow linearly. It doesn't get a little bigger every year at the same rate. It grows exponentially, slowly at first, then faster, then dramatically, then almost incomprehensibly fast toward the end. This is why time, not income, not investment genius, not perfect stock picks, time is the single most powerful ingredient in building wealth through compounding, and we'll come back to that point again and again because it genuinely changes how you should think about money decisions at every age. The $500 math and why it actually surprises people. Okay, let's get into the actual numbers, because I think when most people imagine saving $500 a month, they imagine this. After 30 years, you've put in about $180,000. Maybe it grows a little. Maybe you end up with $250,000 if you're lucky, something in that range. That is not what happens. If you invest $500 a month in a diversified index fund, the kind that tracks the overall stock market and has historically returned an average of roughly 7 to 10% per year over long periods, and you do that consistently for 30 years, you end up with somewhere between $567,000 and $1,130,000. Let that sit for a moment. At 7% average annual returns, 30 years, $500 a month, you're looking at roughly $567,000. At 10%, still historically reasonable for long-term stock market investing, you're looking at over $1 million. You contributed $180,000. The market gave you the rest, somewhere between $387,000 and $920,000 in growth, from the same $500 a month. And this is the part that usually people say, okay, but that's assuming the market returns 10%, and yes, that's fair, returns vary, past performance doesn't guarantee future results, all the standard disclaimers apply, but even at more conservative assumptions, 6%, 7%, you're still looking at life-changing money generated by a contribution most middle-income households could theoretically manage with some intentional restructuring. And here's the part that gets really interesting. If you start at 25 instead of 35, that extra decade is worth more than any rate of return optimization you could do, because you're not just adding 10 more years of contributions, you're giving your money 10 more years to compound, and the later years, as we established, are the most powerful ones. A 25-year-old who invests $500 a month for 40 years is in a genuinely different universe than a 35-year-old doing the same thing for 30 years. Same person, same discipline, same monthly amount, just a decade of difference in when they started. The real enemy is not your income. And this is where I want to push back a little on the narrative most financial advice seems to start with. Because if you've ever consumed personal finance content, books, podcasts, YouTube channels, you've probably absorbed the idea that the key variable is income. Earn more, invest more, build more wealth. Simple. And look, earning more is great. I'm not going to pretend otherwise. Higher income does give you more flexibility, more cushion, more ability to invest larger amounts. That's real. But income alone doesn't build wealth. And I think deep down, most of us know this, because we've all seen it or lived it, where a raise comes through and somehow the bank account doesn't actually grow. The lifestyle expands to meet the income. The subscriptions accumulate. The dining out gets a little more frequent. The vacations get a little more expensive. Economists call this lifestyle inflation. I call it the invisible drain, and it is genuinely the more common enemy of wealth building than low income. Because here's the thing, you don't need a six-figure salary to invest $500 a month. You need a $500 a month gap between what comes in and what goes out. That's it. And for a meaningful percentage of people, that gap exists. It's just currently filled with spending that doesn't map to actual values or priorities. I'm not saying that in a judgmental way. I'm saying it because I've been there. There was a period in my life where I was earning decent money and couldn't figure out where it was going. Not because I was irresponsible exactly. I wasn't buying designer clothes or anything dramatic. It was just a slow, ambient leak. A few subscriptions, convenience spending, eating out more than I tracked, the occasional treat-yourself moment that happened more than occasionally. And none of those individual things felt like a problem. That's the thing about lifestyle inflation. It doesn't announce itself. It just quietly absorbs whatever margin you had before you even think about investing it. The shift that actually helped wasn't a budgeting spreadsheet, although those are useful. It was getting honest about the gap, about what was actually going into investments versus what was being absorbed, and making the investment automatic before I could spend it. Automation is the strategy that beats willpower every time. Let's talk about that last point, because I think it might be the most practically useful thing in this entire video. Human beings are not great at consistent, long-term behavior. We're really good at intention. We're decent at behavior for a few weeks after we've been motivated by something, a video, a conversation, a scary bank statement. But sustained, consistent behavior over 30 years? We are not naturally wired for that. Our brains evolved to prioritize the present over the future. That's not a character flaw. It's just how we're built. This is why the traditional advice, just be disciplined and save, is kind of useless. It's asking you to use willpower, which is a finite, fluctuating resource, to override impulses that are deeply baked into how human psychology works. Every single month for 30 years. That's a lot of willpower. Automation solves this in a way that is almost embarrassingly simple. You set up an automatic transfer to your investment account on payday, before you see the money, before it hits your checking account and feels available, and then you live on what's left. This is sometimes called paying yourself first, and it sounds like a cliché because it's been repeated so many times. But it works not because it's a clever trick. It works because it removes the decision entirely. You don't have to muster motivation. You don't have to choose to invest this month. It just happens, and then you adapt to the amount that's left. The psychological principle here is called adaptation. Humans are remarkably good at adapting to their circumstances. If you've ever taken a pay cut and survived it, or moved to a cheaper city, or gone through a period of reduced spending, you know that after a few months, the new baseline starts to feel normal. The initial discomfort fades. You find the life that fits the available resources. Automation uses that adaptation superpower in your favor. Redirect $500 before you see it, adjust for a month or two, and then, for most people, life mostly continues at roughly the same feeling of financial comfort, but the wealth is now building in the background, quietly, every single month, compounding. The index fund question, because someone's always wondering. I've been saying invest in a diversified index fund without fully explaining what that means, and I should fix that because it matters. An index fund is basically a product that owns a tiny piece of a very large number of companies, hundreds or thousands of them, in proportion to how big those companies are. When you buy into an index fund that tracks something like the total stock market, you're not betting on any single company. You're essentially betting on the overall economy growing over time. And historically, over long enough periods, it has. Not every year, not smoothly. There are crashes and recessions and years where the market drops 30 or 40% and everyone feels terrible. But over 20, 30, 40-year windows, the trend has been upward. The reason index funds specifically are recommended as opposed to actively managed funds, where professionals are picking individual stocks, comes down to fees and outcomes. Most actively managed funds charge higher fees, and when measured over long periods, the majority of them underperform simple index funds after those fees are accounted for. Warren Buffett, one of the most successful investors in history, has said publicly and repeatedly that most ordinary investors would be better off just buying a low-cost index fund than trying to pick stocks or pay managers to pick stocks. That's not a beginner's oversimplification. That's someone with more investment experience than almost anyone alive, giving honest, unpretentious advice. The specific funds most commonly recommended are things like total market index funds or S&P 500 index funds. They have very low expense ratios, meaning they take almost nothing from your returns in fees, and they're available through most major brokerage accounts and retirement accounts, like a 401k or Roth IRA. Speaking of which, and this is an important aside, if you have access to a 401k with an employer match, that match is essentially free money being added on top of your contributions. A 50% employer match on your $500 a month means you're effectively investing $750 a month. That changes the math significantly, and taking full advantage of that match is typically the highest return investment available to working people. While we're on the topic of accounts, let's talk about something that genuinely moves the needle and doesn't get enough attention in regular conversation. The type of account you invest inside affects how much of your returns you actually keep. In a regular taxable brokerage account, your investment gains are subject to capital gains tax. You invest, you grow, you pay taxes on the growth. Fine, it works. People build wealth this way. But in a tax-advantaged account, a Roth IRA, a traditional IRA, a 401k, the rules are different. With a Roth IRA, you invest money you've already paid income tax on, but then all the growth and all the withdrawals in retirement are completely tax-free. You put in after-tax money. Decades of compound growth happen inside the account, and when you're 65 and you want to access it, the government doesn't take a cut. Think about what that means in practice. If your Roth IRA grows from $50,000 to $500,000 over 30 years, that $450,000 in growth is yours, not partly yours after taxes, all yours. The contribution limits for Roth IRAs are roughly $7,000 per year as of the time I'm recording this, which works out to about $583 a month, almost exactly the $500 a month we've been talking about. So if you're putting $500 a month into a Roth IRA inside a low-cost index fund starting in your mid-20s, and you do that consistently for 30-plus years, you're looking at $1 million retirement account from which you can withdraw completely tax-free. That is the actual path, not a loophole, not a secret, a completely ordinary, legal, and available to most people financial strategy that a surprising number of people either don't know about or haven't gotten around to actually setting up. Why most people still don't do this? The psychology part. And here is the part I think matters most, because by this point in the video, you probably understand the math. You maybe even feel a little lit up about it, a little hopeful, and you might be wondering if this is so clear, so available, so demonstrated by decades of data, why aren't more people doing it? This is genuinely my favorite question, and I think the answer has multiple layers. The first layer is awareness. A lot of people simply haven't seen the math laid out clearly. They have a vague sense that investing is good, that a 401k exists, that compound interest is a thing, but the specific, concrete picture of what $500 a month actually produces over time, many people have never seen it, and vague awareness doesn't motivate behavior the way concrete understanding does. The second layer is present bias. This is the psychological phenomenon where the present feels disproportionately real and important compared to the future. A dollar you could spend today on something enjoyable feels more valuable to your brain than a dollar you'll have in retirement, not because you're irrational exactly, but because the future is abstract and the present is vivid. Future you is, in a psychological sense, almost a different person, and it's genuinely hard to sacrifice for someone you don't feel fully connected to, even if that someone is you. The third layer, and this one is less talked about, is a kind of learned helplessness around wealth. A lot of people, especially people who grew up without much financial cushion, have absorbed a deep background belief that wealth is for other kinds of people, that the rules of compound growth don't really apply to them, or that something will go wrong before the payoff materializes, or that it's naive to plan 30 years out when life is unpredictable. These aren't stupid beliefs, they often come from real experience, but they are beliefs worth examining, because the math doesn't care about your background. The snowball doesn't ask who you are before it starts rolling, it just rolls. And the fourth layer, maybe the most common, is simply starting costs. Opening an investment account, figuring out what to invest in, setting up automatic contributions. It's not actually complicated, but it feels like it could be. And when something feels complicated and slightly unfamiliar, the easiest response is to delay until you feel more ready. The problem, of course, is that more ready often never comes, and every year you delay is a year of compounding you don't get back. What starting late actually means, and why it's not an excuse to give up. I want to spend a moment on this because I think there's a version of the earlier you start message that quietly discourages people who aren't early anymore. If you're 35, 45, even 50, and you're hearing the earlier you start, the better, it can feel like a door closing, like the optimal moment passed and now you're playing catch-up in a game you can't win. That's not the right way to read it. Yes, the math is better the earlier you start. That's true and worth knowing. But the second best time to start is right now. Not because that's a cute motivational line, because mathematically, every year you invest still compounds. A 50-year-old who starts investing $500 today will have something meaningful in 15 years that they absolutely would not have if they waited another 5 years to figure things out. It's also worth noting that at later ages, you often have more income, lower fixed expenses if kids are grown, and honestly, a more urgent motivation to focus on retirement savings. Catch-up contributions are allowed in retirement accounts once you're over 50, specifically because policymakers recognize this reality. The point isn't to feel bad about the years you didn't invest, it's to not let those years become a reason to not start today. The lifestyle design piece nobody talks about enough. There's one more angle I want to cover before we wrap this up, because I think it's actually the most important shift and the one that ties everything together. The question most financial advice is answering is, how do I accumulate wealth? But I think the more generative question is, what kind of life am I actually building towards, and does my current financial behavior serve that life? Because here's the thing, the math of $500 a month is powerful, but math alone doesn't sustain behavior over 30 years. What sustains behavior is meaning, connection to purpose, a clear, vivid sense of what the money is actually for. And retirement as a concept is honestly a little abstract and not super motivating for most people in their 20s and 30s. Retirement feels far away. It doesn't have a face. It doesn't smell like anything. But financial independence, the ability to choose your work rather than needing any job that pays enough, that's something people can feel. Not being stressed about money is something people can feel. Being able to take care of the people I love without fear, that's vivid and real. When you connect the $500 a month habit to something specific and emotionally resonant, when you can see what you're building towards, not just how much you're accumulating, the behavior becomes easier to maintain. It becomes part of how you see yourself, part of your identity rather than a sacrifice you're making in the hope that math works out. This might sound like a soft, psychological addition to what's basically a finance video, but I genuinely believe it's where most financial plans succeed or fail. The spreadsheet can be perfect. If the emotional connection to the goal isn't there, the behavior won't hold. So, what do you actually do on Monday? Let's make this concrete. If you don't have a Roth IRA, open one. Most major brokerages, Fidelity, Vanguard, Schwab, let you open one online in about 15 minutes. No minimum balance required. It's simpler than opening a bank account. If you do have one but aren't contributing consistently, set up an automatic monthly transfer. Pick a date, ideally the day after payday, and automate it. Remove the decision. Choose a simple, low-cost total market index fund or a target date retirement fund and put the contributions there. You don't need to research individual stocks. You don't need to wait until the market feels calm. The best time to invest was years ago. The next best time is now. And if $500 a month isn't immediately possible for you, if your real number is $200, $100, or even $50, start with that. Seriously, start with what's real and available right now, because the habit of investing, the identity of being someone who invests, the momentum of watching a balance grow even modestly, all of that is more valuable than waiting until the amount feels impressive. Closing. I want to come back to where we started, that feeling of millionaires are people who did something I can't do. I hope, after walking through all of this, that belief has softened at least a little, because the actual math tells a quieter story, not a dramatic one, not one involving genius or luck or perfect timing, a story about a consistent monthly habit, a long enough timeline, and a financial instrument that has slowly, unevenly, but reliably over long periods rewarded patience. The $500 a month path to $1 million is not exciting. It's not a pitch. It won't go viral. Nobody's making a movie about someone who maxed out their Roth IRA every year for 30 years. But it works, and it's available right now to an ordinary person with an ordinary income and an ordinary level of financial knowledge. The thing I want to leave you with is this: you don't have to figure everything out before you start. You don't have to earn more, know more, or feel more ready. The version of this strategy that works is the imperfect, started today, adjusted as you go version, not the perfect plan you execute flawlessly starting from an ideal position. The snowball doesn't care how it gets started. It just cares whether you push it down the hill. And the hill is long, which, if you start now, is exactly the point.